always ask someone, because they'll complain about drug prices, and I'll ask them, what day is it that you want to die? Invariably, the answer is not today. So healthcare is going to be expensive because it's the one thing that you totally need is to be alive.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to the Bull of Wall Street podcast. I'm Jim Worden, Chief Investment Officer with the Wealth Consulting Group. I'm joined by one of my co-hosts, Paisley Nardini with Simplify. We have a very special guest with us, Mike Taylor, who works with Paisley. Paisley, can you give us a little bit of intro about Mike, and then we'll kick this off?
Yeah, happy to be back. I have not sat in on a podcast with the Bull of Wall Street for a couple months now. So I'm a little bit biased with regards to today's guest, which, as you already mentioned, Jim, is Michael Taylor. And Mike and I work together in a capacity at Simplify Asset Management, where I'm employed. And Mike and I got to know each other over the last year and a half since I joined Simplify, because he is the portfolio manager on one of our healthcare ETFs. So we're going to talk a lot today about healthcare. We're going to talk about Mike's kind of background and his beginnings. But I would say Mike is one part scientist, one part hedge fund manager. And then I feel like your total is even more than the capacity of 100%. I feel like you have a lot going on, Mike. You have a lot of really cool endeavors. You have such a unique background that we're going to dive into today. And so just maybe for starters, if you wouldn't mind kind of walking us through your initial beginnings and how you made that transition from science to finance, and ultimately what that brings to you in your capacity today as a manager of a healthcare fund.
Thank you so much, Paisley, and thank you for having me today. When I look back on my history and how I got here, it doesn't seem abnormal. I'm sure it is to many, because most of the scientists that we were just talking about earlier that come to Wall Street, it's a rare event for scientists that develop drugs and so forth, very highly technical individuals, to make it to Wall Street and make that transition from a belly to the bench with the whiteboard and the marker and into actually running numbers and then running a hedge fund. It's a strange set of skills to do both well. And so I transitioned out of doing drug discovery and development in the late 90s. Went to business school because I discovered that this job existed. Had I known that the fail rate for this job is like 97%, I probably wouldn't have done it. But I was young, I was naive, and I honestly couldn't find a career that really interested me for the duration. I was very fortunate as a scientist in that I played a large role in developing 2 drugs that got into humans, and did so about at 29. So from the ages of 26 to 29 in a small biotech company, and doing that and getting to that spot could be the highlight of someone's career. It's a rarity that you get to work and build a drug from the whiteboard to the animal studies to going to humans, that you even get that shot to do that in an entire career. And here I am.
What drugs were these?
There were 2 gene therapeutics, one for macular degeneration, which is a blinding of the eye, blood vessels start to poop out. And then the other one was for prostate cancer.
Wow.
Both using an adenovirus gene vector, so a virus delivering genes. And what was actually, and I don't talk about this much, but what really got me into this business was CNN FN. Remember, they used to have that financial news network, and it was It was up in the corner of the screen in my laboratory, right up in the corner on a little TV. And a biotech analyst came on. And he started talking about the company that I was at. By the way, the company I was at was like, we had like 80 people at the company. It's very small. Talking about it. He said they have these 2 drugs that are going to work, and they're going to the clinic, and it's
you were like, that's me.
I said, holy shit, that's me. But I knew something that he didn't know when he was promoting this. I knew with 100% certainty that those drugs were completely going to fail in the clinic. And I knew why. And the company had to push these drugs forward in order to raise money to keep the company going. We didn't talk about it, but developing these, I knew it was not going to work. And it was in that instance that I learned, this was 1997. This is in that instance that I learned that you can bet on stocks that go down, you can bet on stocks that go up. And if you have asymmetric knowledge, not insider information, just asymmetric understanding, you could actually become an armchair scientist, travel around the world, get a Harvard education every minute of every day, and somebody pays you to do it. And I thought, oh my, what? That's a job. I got to do that. So I went to business school and I left science and fortunately got into my first job. I ended up becoming the head of healthcare at Oppenheimer Funds, which was an enormously way too big seat for me. At the time, this is $170 billion under management in 2000. And I ended up being the head of healthcare. And they know it now. I'm still friends with those guys. But at the time, I didn't know what an HMO was. I just knew about drug development a little bit. And it was really a trial by fire where could I learn the space and med tech and everything else quick enough before they find out that I don't know anything and I'm going to get fired. So I figured it out quick enough and performed well enough. And I actually ran an $8 billion healthcare carve out of that fund.
That's incredible.
And after that, I went into hedge funds in around 2005. And I spent most of my career running a long short book at Citadel and then Millennium for the most of my career. And here we are doing something for a great cause, great for our clients, great for investors, and great for women that suffer from breast cancer and families that suffer from breast cancer. So we run the Pink Fund now. It is an actively managed ETF it's all healthcare, or vast majority of it is healthcare. And the net proceeds of that fund, the fees, goes to the Susan G. Komen Foundation for Breast Cancer, as does my compensation. And
I think the check behind you is a dated check, maybe from one of these.
Oh, it is. It's right there. I see it.
Yeah, because I think we've given over $350,000 to Susan G. Komen now with the net proceeds of the Pink Fund, which, to your point, to be able to provide alpha, attractive investment results, but also do right by society by donating proceeds. It's one, I think, the only ETFs in the market that offers that, which is really incredible.
And I was I was in a fortunate place in my life where I could do that, where we could do something totally unique and do it for free and educate the world on breast cancer and help all these people and deliver superior returns, which is always our goal. And our incentives are aligned, even though I don't get paid directly by this. I'm one of the largest shareholders in the fund, personally.
Yep. So
that's pretty rare too. I feel like, Mike, going from a hedge fund, running hedge fund money, and the profits there are pretty high, and a lot of society looks kind of down at hedge fund managers and how much money they're making. But you went from there to running an ETF, and all the proceeds, all the net profits go to Susan G. Komen. That's very, very admirable.
And we're very fortunate that Simplify made it happen. This is all Simplify. I could not have done it solo at all, ever.
Well,
Paisley.
Yeah, I paid him to say that.
It takes a whole team to make this work.
Yeah, maybe one other thing I want to talk about too, because we're definitely going to dive into healthcare in today's conversation. But one other thing that's really cool about Mike is Mike's son's Max. And Max is doing some really cool stuff in the racing space. So just a quick platform and a quick plug for what Max is doing. Tell us everything.
Oh, he's got the Max Taylor hat on. I love it.
Yeah, we even got a new logo, the whole thing.
Wow.
So Maxie is, well, so 5 years ago, and this is a crazy story. It literally, now I know how crazy it is. And you've seen the whole way where you're like, oh, Mike's going out with his son to try go-karting and just go in a parking lot and drive in circles with a bunch of drunk dads. I really thought that that's what we were going to do. And that's not what happened at all. 5 years ago, he got into a go-kart because he watched the Drive to Survive series, and I love cars, and we never really watched racing though. And he saw that, all these guys started out in F1, they started out in go-karts. So we want to try go-kart. He's 13 years old. All right, let's do it. So we join a little golf club in New Jersey here, and we go down to the track, and he gets into the go-kart, and he's literally Lightning McQueen. And you could tell right away he's got something. 18 months later, he's national champion.
Wow.
Nobody's ever heard of that. These kids started
incredible.
5 years old, and they're like a race child through their entire life, training to get to IndyCar or F1. And 18 months later, he's national champion and podiumed for many championships in that first year, which was he finished third in the world in his first year.
That's incredible.
So it was like 19 or 20 months after he got into a go-kart. And I was urged by Gene Haas, who owns a F1 team, Haas F1. And he said, Max has to go into open wheel racing right now. And that's like IndyCar or F1. And so we tried that out. 18 months later, he was junior world champion. He nearly won two of the mid-level and the junior championship at the same time in 1 year. In fact, never in history has anyone podiumed for two championships in 1 year. So he has so many records that he picked up. Stunning. And that was 18 months ago. Yeah. So now we're 18 months after that, and he's the lead driver at Andretti.
Amazing.
Running the 28 car, and the 28 car is the one that won the championship last year. And he's really bloomed in that car.
How proud are you?
Preseason, well, it's more exhausting, I mean, it's a lot. It's a lot, and it's so we just had our first race of the season last year. He started on the pole, qualified on the pole at St. Petersburg, a track that he's never raced on in this car, and he has real incredible, this world-class competition in Indy Next. It's broadcast live on Fox Sports, and there's 100,000 people in the audience, and then millions on TV watching this sort of thing. And he ended up finishing P2, which was a good start. It's all about points for a championship. So I think we have a really exciting year packed, and that's my other full-time job. Yeah, is trying to manage that, and
so exciting. So, like, are any big races coming up? Anything that like listeners should be on the lookout for? Because I mean, once you kind of know someone in that, you want to follow them and cheer them along.
Sunday at 10 a.m. on Fox Sports this Sunday, he's racing at Arlington, brand new track, Arlington, Texas, and the IndyCar race will be on at 12. So basically, Max's series, Indy Next, is kind of the warm up for the fans. Before the main event, which is IndyCar, and hopefully you'll see him hopefully as a professional driver next year.
I love that.
That's what it looks like. So
congrats.
This whole thing has been much more than I ever expected.
Yeah.
So
super.
And we're so thankful to Susan G. Komen. They allowed us to put their branding on the car, and so he's running a horrifyingly intimidating giant pink car. And I love it.
I love that too. That's wonderful.
That is awesome. Well, we may have to have him on the podcast too at some point.
And I have my pink Simplify mug here today to support. So
yes. That's wonderful. That's really my part-time job. My son, it's a high commitment, but I enjoy it. And it's really about excellence. And that's what I've done for my career, is try to put out the absolute best that I can, whether I'm doing it for a little money, a lot of money, or no money. If my name is attached to it, I'd like to just put out the absolute best that I can do. And I'm really proud of Max and that he's trying to do the same thing with what he enjoys. And he's a little fella. He just turned 18.
Yeah.
So
he's got a lot of success ahead of him.
Congratulations,
thank
Mike.
you.
That's
Thank
awesome.
You. So on to healthcare, pink markets.
Yeah,
what the heck is going to happen next?
Yeah. So I want to start super high level, and then we can kind of get into the weeds and take some different turns here. But as a sector, healthcare, I would say, has struggled relative to the broader market, which most things are if we're just comparing this to simple market cap, of course. But there's been some policy implications, regulatory, some stock specifics that have maybe caused some of this lag of healthcare relative to the S&P. Do you think that the market pricing in some of this discount in the healthcare sector is warranted? What's your take kind of on a macro picture of what's driving some of this? And is this here to stay? Or do you think healthcare is kind of ripe for some outperformance?
It is extremely ripe for outperformance coming into 27. And actually, it'll be fourth quarter. And that's my macro view, my macro backdrop. The comps for the world on a cyclical basis are unbelievably difficult going into 27. Also, the comps for healthcare are unbelievably easy. And we have to think about, what are comps for healthcare? Well, it's really, how much does the White House hate you? And we're kind of just coming off of apical hate. And so the comps now are really easy because the damage has been done beating up on healthcare. Remember, the next year, after November, Trump doesn't have to run for anything ever again. So, he really beat up on healthcare really as a political measure. And that's what it is, because everyone likes to beat up on healthcare. And so we kind of got a 1, maybe 2 year window where we don't have politics against us. And we actually have physically very easy comps and a backdrop where the rest of the cyclical world has very difficult comps. And of course, there's other aspects too, like the credit issues that are now starting to percolate. They're extremely meaningful and much larger than 2008 and much more opaque than 2008. I don't want to say 1929. It's not to that level, but it's very similar in that I'm involved with private credit. I do a lot of things on the side. And when you take a look at a pool of credit, $1 trillion, where it is, what the collateral's tied to is completely opaque. You don't know until the credit blows up, and then you find out. And when you find out, unlike in 2008, you had a house, which was the collateral, and you knew the address, and you knew what it was, and you could look at it, see it. Here on private credit, you can't see anything. You have no idea. These are private companies and private loans that do not publish their information, and frequently you can't even get an address. So I'm very, very, very concerned, as are many of the smartest guys out there. And I talk to, or at least I like to think I talk to, some of the smartest folks out there. Frankly, there are many names that you have never, the biggest names in finance that you've never heard of. And that's really the true biggies are actually not terribly well known, except for Mike Green.
Except for Mike Green, little plug for Mike.
Who I talk to every day.
Yeah, Mike Taylor is good friends with Mike Green, who's another colleague of ours.
We've been best friends for almost 20 years.
Yeah.
Wow.
Yeah.
So maybe the follow-up question I would have then, as it relates to the healthcare sector, and you mentioned a lot of the headwinds or maybe politically, regulatory, kind of headline driven. If those are behind us. I mean, just wondering around some of the drug pricing that's been in the news in the last couple months. Obviously, Trump, wanting to ensure that there's not monopolies here to make drugs unaffordable for consumers. Mm-hmm. But from a drug pricing and then the other end of the spectrum, how much is tariffs related news or impact driving in the healthcare sector? And are these two headwinds that are maybe behind us, or how do you view this?
I have to credit, even though, healthcare has been injured by the White House activity and intentions, I have to credit Trump specifically greatly for what he's attempted to do. And it is to right many of the imbalances that are out there. One of the largest imbalances in healthcare is that the US pays a greatly premium price on drugs, and it subsidizes the rest of the world that gets it for peanuts almost. And there's a reason for it. Outside the US and national healthcare, UK, you could go to Canada, all through Europe, everything is rationed. They don't talk about that. But if you want a knee, get in line. You need a hip, get in line. You're dying of cancer and you're 80, you're not actually going to get treated too aggressively, because how many years do you have left anyway? They actually do calculations like that where you are not terribly valuable as a human. The US doesn't do that. We value human life and wellness far more than the rest of the world. The rest of the world doesn't have too much of a choice, though, because the bureaucrats are in charge. And it is the biggest issue in every country with socialized healthcare. The biggest issue is how bad it is and how expensive it is. And as you know, if you let the government run anything, it will be run so badly you cannot believe it. And that's what they're stuck with, because they thought, hey, it's a good idea. It's not, in my view, a good idea. So Trump came in trying to fix that wrong and saying, well, I'm going to tariff all you guys. And part of the solution is you're going to pay a hell of a lot more for drugs, because sometimes the drug price over there is 5x what we're paying here. And often it's just not available at all. I'm on a drug. I have an autoimmune condition, and that actually is what ended my hedge fund career a number of years ago. And many of the drugs that I've been on are simply not available outside the US. A surgical procedure that I had that's experimental up and down my spine to totally changed my life in an amazing way, where I'm, 90% of the man I used to be, which is a huge improvement. Completely not available anywhere else in the world.
Wow.
And these are the sort of things that you can get done. If you have an off-menu ailment, this is the place to be. So all these socialized healthcare, it's really made for run-of-the-mill cookie cutter sort of things. But if you have anything that's slightly off or, I don't know, they can't treat you and they won't treat you. And that's the agony of healthcare outside the US. So I credit Trump. He really made a valiant effort to press this. Now, with the tariff thing being all changed because of the Supreme Court, I do not know what the net outcome is going to be. We're actually going to find out a lot more between now and June. But what it means for healthcare is that whatever bad news there is, it's already priced in. And looking forward, the comps are incredibly easy. And I have to emphasize, though, that where we are in medicine in the world is a renaissance, a total golden age in discovery and development in everything, from diagnostics to surgical to drugs. It moves so quickly that I cannot believe it. I'll give you an example. There's a rare indication to treat something called nephropathy. Your autoimmune system attacks your kidneys, and they call IgA nephropathy. I know, a lot of freaking words and letters. And there's nothing to treat it except steroids, really, and a few things off label. And in the last year, or within this year, there's 3 companies that are going to be coming out with advanced data. One's on the market, the other one's coming to the market, and the next one I actually think has the best cookie cutter, the best drug, the best mousetrap. It's a name that's in the Pink Fund, by the way. And they were able to do that in such a short period of time. I cannot believe it. So we identified a disease, found a functional, really cure. People won't die from this anymore. And boom, we have 3 companies with drugs out there.
Wow.
And that could not be done 12 years ago.
So is all of this being expedited, driven just by advancements in research? Is a lot of it driven by AI, some combination of both, being unrelated?
I get that question all the time on AI. Science has been using AI a long time. what you would call artificial intelligence. It's just become, it is now going to be a lot better because of what they're building. The processing power to figure out what proteins are going to do is like prohibitively expensive to really get the computations down. But now that we're building square miles of farms, it's going to make it that we can really run informatics and figure out things that in time. It's all that work being jammed into a tiny amount of time. When I was in the laboratory, I'd be in the lab up till 2, 3 a.m. all the time doing experiments with a pipetter. You're going back and forth and setting up the machine and put it in. Very, very manual job 25, 30 years ago. And now you have machines that can do 1,000x of what I could do. It's stunning. I got as much done as I did. I look back on it and I'm just like, all those nights of toil. All I had to do was wait 8 years and then you could do 1,000x. But that's really the benefit that we're living in right now, is the failure rate, meaning that the attempts to find failure at the low, the early stages is really high, meaning you get a lot more shots on goal. So you can see fail, green light. What's that? So you get all these more shots, and that's why things are coming so fast. And we're in the parabolic phase now.
Yeah, I mean, I feel like a lot of what our industry has been talking about really since May of 2023 is AI having a trickle down effect into the smaller caps, mid caps, these lesser known efficient parts of the market. So not to oversimplify your messaging here, but is it fair to say that healthcare, that is a large enough tailwind for the sector, broadly speaking, the next couple of years, it can benefit from adoption of AI and efficiencies?
I'll say this here. Science is on the cusp of truly understanding aging. And that is going to be the next very, 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 very big thing that will last for hundreds of years of development and altering the cadence of aging. And I can go into specifics if you want as to how and why. And I've had views as to how and why for the past 25 years. But we're on the cusp of the first drugs in the next 10 years to alter how your cells age. And that's going to have a profound impact on humanity.
And then we all become robots
more gracefully for a longer period of time.
Yeah.
And, that's the final frontier. And I believe that we are now within a distance that I can see it. And that's exciting. Extremely exciting for me.
It'll make the GLP-1 renaissance that we're in the midst of here seem probably like peanuts relative to the advancements that it sounds like you're portraying.
And GLP-1s, I remember, so by the way, GLP-1s have been out for a very long time. I remember developing investing in the first GLP-1s. And they were tiny drugs because they didn't have a pharmacokinetics, meaning they didn't last long enough in the body. You'd have to inject yourself every day. And they weren't actually terribly potent. They basically got your sugars down for diabetes a little bit. And that was the beginning. And then they realized that we could improve the potency and change the PK, turn it into a once weekly shot and maybe more. And now we have a pill. So that little tiny drug from like 15 years ago, is it? It's almost, no. Yes, it is. It's like 12 years ago. 12 years ago, there it is. So, and that's where it started. And they were able to innovate and improvise and get it to something that's suitable for the masses with whiz-bang results. GLP-1s have transformed sleep apnea. You don't have to have sleep apnea anymore.
I wasn't aware of that.
They transformed the need for a fat suit.
Was aware of that.
So
yeah, I mean, it's fascinating. I mean, that's been a lot of the attention, I would say, in the healthcare space. Anywhere you look, you walk by a bus stop, it's an ad on TV. Like everywhere you look, it's some form of GLP.
And the orals just launched.
Yes,
they just launched.
Yeah.
Novo Nordisk, which were size, here in pink has an oral, and Lilly's oral comes out probably in April. Lilly's drug is a little bit more potent than Novo's, but I believe in the real world, Novo's drug is going to be much better tolerated than Lilly's drug. And that's a real alpha trade that we have on right now in the pink book, where we're meaningfully sized Novo Nordisk and we're meaningfully underweight Lilly.
Relative to like market cap weighted sector?
Yes.
Yeah.
Yes.
Okay.
Yes.
Yeah. So I've got a question on that. So like in the past, we have some quant driven models that have owned both of those. We don't own them currently, but vastly different performance when you look at Lilly and Novo Nordisk. What do you make of that? Is that the market not discounting everything the way it should, or discounting too much? I'm just trying to understand kind of the fundamental backdrop between those two.
I was very vocal last year that Novo could not make numbers, and it's really just modeling. And it's not that hard. It's just surprising how many don't model that well, or or maybe we've just been doing this for 25 years, so it's not that hard for us. But they couldn't make numbers, and it was really a pricing and COGS, cost of goods sold, that they couldn't get to the bottom line. And additionally, we're very cognizant that for the injectable market of GLP-1, Lilly has the superior drug. And so they kept getting share, and Novo kept losing share. And so they had a scale problem, and it manifested in the stock going from 140 to 40, which is a giant move for a mega cap.
Yeah.
And now, as the injectables kind of flatline and start to decline because the orals come on, I think we may see it go the other way, where they realize that Novo actually has a superior drug to Lilly, and Novo ends up getting the share. And I don't think anyone has that trade on pretty much.
Yeah,
I'm pretty sure, because that stock's down a lot.
It is down a lot.
Yeah. How do you think too, Mike? I mean, in the past, your hedge fund days, your ability to take, full long short positions, whereas now you're focused on a long only book. Like you said, your relative positioning becomes to the benchmark weight. Do you feel like within the healthcare sector that affords you enough kind of like degrees of freedom? I guess you're kind of just bound to the fact that it's a long only, but how do you think about expressing views, whether it's you're holding them, but it's a relative underweight or overweight, or whether you're just not holding them at all? Because I think as it relates to how you manage that, it is an active expression. You're not benchmark tethered per se.
We can run it. Sometimes it looks similar to the benchmark. And other times, like right now, where we have a lot of alpha ideas, it will look very different than the benchmark. And and really it's idiosyncratic. For instance, in the case between Novo and Lilly, their drugs, it really comes down to the PK, the pharmacokinetics of the drug, and how long it stays in your body and how long it vanishes. So in the study, the phase 3 data, and it'll look that way in the label too when Lilly's gets approved, they look pretty similar on tolerability, and so people are like, good, okay, Lilly's going to win this battle. The thing is, in the real world, that's not how people take these drugs. So in a clinical trial, the bell rings, you take the drug, and someone's calling you to remind you, and the whole thing, and it's very high compliance in a clinical study. In the real world, what's going to happen is that you're going to miss a script for 3 days. And you're going to miss 1 day, 2 days, 3 days. You miss it, they don't have it in stock, whatever. And it happens all the time. People miss their scripts all the time, just by a few days. This will happen. In my view, when you go to take that Novo drug after not taking it for 48 hours, you won't notice much of a difference. But when you take the Lilly drug, you're going to start vomiting like you can't believe.
Oh, no.
Yes, because They have a titration thing where they step up the titration. When you first take the drug, you get to your therapeutic level and it stays there. Now, the problem is with Lilly's drug, as soon as you stop taking it, it craters down and it's gone in a day. So you have, or 2 days. So you really have to take this drug every day or your body gets rid of it and used to it. And once you introduce that therapeutic level again, immediately, boom, you'll start vomiting. Novo's drug sticks around longer, has a different pharmacokinetic profile, a bit, but it's going to be enough so that you're not vomiting and calling the doctor. Doctor's going to get that call and get so annoyed by it, they're never going to write Lilly's drug again.
Interesting.
And I think we'll see that in the numbers in the fourth quarter of this year. After 2 quarters of launch, we'll start seeing in the numbers something's off. And that's really that's an example of how we would make a lot of money running a hedge fund. Yeah. Because I could have $300 million versus $300 million bet. So literally bet size is the size of this fund. And we could do that. And those are exciting moments for us when you kind of know something and the world hasn't figured it out yet. And yeah, but I think some of my super specialists that I've trained a number of people that are running big hedge funds now. They're aware of this. But I'm certain not everyone is. Yeah. And now everyone listening to this podcast is aware. Yeah.
Secrets out.
So in my view, if you are going to go on to a GLP-1 oral drug, it's not quite as effective as injectables, but it is easier to take. I recommend, just my own view, the Novo Nordisk drug.
Interesting.
In no way is this podcast.
You still own some Lilly in your portfolio. Is that?
Well, we're massively underweight.
Yep.
Okay.
So you may not know this. The benchmark is 14%.
It's huge. Lilly. Yeah. Okay.
That makes sense. When I talk to investors, such as not you, but many RIA and others, they don't realize that. And so they'll own in their book XLV and then a giant slug of Lilly on top because it's GLP-1. So I got to own it. Oh, yeah. And they don't realize they have a massive position in their book exposed to Lilly. They don't know it. And so I try to educate them on it. And that's why we're set up the way that we are. We think this is how it's going to play out. So that's kind of like a flavor for one of the many, 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 many things. Like, for instance, you go down the line, we own a meaningful position in an eyeglasses company called Warby Parker.
Love Warby's.
Oh, yeah.
I got mine right here.
There you go. Oh, that's it. That's your
There you go.
Warby's a really boring company. They have 300 retail outlets in the United States, so very small. And if you walk into any Warby Parker, there's 2 or 3 clients in there at any given time. They have 12 to 13 employees in total per store. That's it. So it's a very scale business. If you could turn that number of 2 people in the store to 20, well, they could do something with that. And they are one of the exclusives for the Google glasses, which we will see in either April or May.
Or Google, okay.
Google's first time. We haven't seen the product yet, but Warby Parker is going to be one of the very few sellers out of the retail channel. And they, in fact, designed and made the frames that go with the Google glasses. And so everyone's kind of dialed these numbers in and said, okay, Warby Parker is going to do this if they sell 1 million pair of glasses. And you can model that out. But when we looked at it, I realized what they're missing is the foot traffic. It's not the glasses they're going to buy. It's all the other crap they're going to buy. Because that store normally has 2 or 3 people in it, and now you're going to have 30 sampling and trying out the Google glasses, just like iPhone store, where you go and you play around the phone, you play with the camera, you learn all the new features, and what do you buy? You buy a bunch of doodads, because, I need a new case, and there's a cord there, and whatever.
Charger.
It's going to be the same thing with Warby Parker. They're going to 10x the foot traffic in their stores.
Wow.
And their gross margin on essentially everything they sell is 50%. And the number of employees don't change. It's still 12 or 13. That's it. So they're going to smoke numbers like you can't believe over the next 2 years. And depending on
Wow.
how big Google Glasses would be, it could be a lot more. They'll probably double their store footprint. So we like that. And so those are things that are healthcare related that Pink
Yeah.
looks very closely at. We look at, animal products, animal drugs, animal distributions, pet supply.
Oh, yeah.
Even we have a position in 3M. 3M.
I saw that. Yeah.
The biggest material input for everything that goes into a hospital. All of it is made at 3M. Every filter.
Wow.
Every single. So it's something that I've watched, and they actually have a real turnaround story underway at 3M. It's taken 15 years to find the right person to do it, but they finally did. And so those are like. So we go a bit off the beaten path that other healthcare funds don't do. We look at consumer, we look at all these other things. And usually our competition is looking specifically at HMOs, med tech, diagnostic, distributors, and drugs. And that's it. And that's what they play in. And we just cast a wider net.
How do you think about the sector in its totality and kind of the return dispersion or opportunities amongst all of these stocks? I mean, the market is always so focused on the tech sector, and there's a couple big names that are leading the charge. But as it relates to, and many of the individuals listening to this episode are probably in an allocator seat at their various firms. So thinking about the passive versus active discussion as it relates to healthcare, obviously you're biased, I'm biased, Jim might be biased as well, and thinking there's opportunities to pull out alpha as well as risk mitigation through active management here. But can you talk about how you view that?
We think a lot about, and what also makes Pink a bit different. Usually the folks running these healthcare books, they're so healthcare specific that they don't really pay attention to the rest of the world. It's just my space and my names and what is going to outperform relative to everything else within my group. And we spend a lot of time figuring out what's happening in the world so that we understand where healthcare fits in. Are the flows going to be positive or negative? And there's two really big inputs for flows for healthcare. No, well, it's three. Number one is the comp, meaning we've had a very, very difficult year of negative interest associated with it. So that's easier. That's going to be a positive flow because there just won't be as much bad news. And it could be meaningful. Number two is going to be, of course, the fundamentals within, aside from the politics. And then number three is Amazon going to up their AI CapEx next year and make it $250 billion? Or is it going to go to 190? If it's in 190 and we start comping negative on the build out, this whole market is going to blow up. And healthcare will become very popular very suddenly. So
you still view healthcare then as a more defensive sector in that type of environment?
Oh, yeah. Look at healthcare has actually outperformed. Look at Johnny John up 17, Merck up 10, Amgen up 15, Pfizer. Oh, no. Even Pfizer is up 9%. And there isn't a universe in any year that should ever be up anything. It's up because SaaS blew up.
Yeah.
Literally, just take a look at the software stocks and take a look at how it's a perfect inverse.
Sure.
They just selling software. They don't know where to put it, and they put it in healthcare. Do they know what they own? No. They just bought an index. They bought an ETF. Mm-hmm. Usually.
So yeah, I got kind of a follow-up on that, if you don't mind. So within healthcare, you've got a lot of different, you mentioned Johnson & Johnson, you got Merck and Pfizer. I mean, I feel like you got all these traditional big pharma, pays a good dividend, not too volatile. They behave kind of defensive, almost like staples in some ways. But then you have all the biotech companies that, it's a lot more volatility, right? So like they're both within healthcare, and then you got the equipment, and then you got the healthcare insurance providers. How does that mix change over time? Do we lean more into the developers and drug discovery firms and less, in some of these like traditional big dividend payers? How do you see the world, and how does it change?
Wow. Well, we have an incredible demographic moment right now. And it's going to be a problem for the HMOs, and that they're going to have difficulty growing organically. And it's only begun to manifest in the past 2 years, for the difficulty getting lives. And I think that'll change with immigration positive versus immigration negative. But I think they're mature businesses and under the microscope. And so in that regard, it really is like a utility. Now, the drug space, though, believe it or not, there's in the past 4 years, there's been wild dispersion among pharma companies. So even though they do offer a dividend, their performance on a relative basis is
all over.
very idiosyncratic. I mean, extreme dispersions. And it's because their businesses, Lilly's business is totally different than Johnny John's business.
Yeah.
Totally different. And same with AbbVie, and then Merck and Amgen. They all have Gilead.
Pfizer
specializes almost entirely in HIV. And its only competition in HIV is GlaxoSmithKline and Merck. And both of them are distant seconds because they were a better mousetrap. And I was one of the earliest investors in Gilead in 2000. I remember it well, before they came out with their first HIV drugs. So there's a lot of alpha and dispersion in this group, and Pink tries to make the most of that by having meaningful overweight and underweight positions. For instance, we have, I think, a 0 weighting in Pfizer and Bristol Myers. I don't think we have any Vertex right now. So we have really big bets on relative to the benchmark.
Yeah.
So that's one of the things that we will do very, very differently. We'll have positions on for a reason, and hopefully a good reason, and hopefully it'll work out. So far, so good.
So far, so great. I might also ask too, you mentioned just something about like pricing power and some of the rotation that we've seen year to date, some of that driven by the software underperformance. But if we think about from like a macro backdrop, a lot of this talk around stagflation with slower growth, higher inflation, and the potential tailwinds that provides for this sector. I mean, typically when we have this kind of risk off trade, and I don't know if year to date, what we've seen some of the rotation, some of it's a little bit risk off, some of it's more just going to sectors and asset classes that have better pricing power, that have stickier earnings. And so it seems like healthcare is well positioned if you can navigate it through active management for this macro backdrop. And I know we kind of just touched on that, but to your point, some of the headwinds that have been in place from political leaders and such, if that's behind us and investors are starting to look for, higher quality earnings, stickier pricing power, some more moats around them, healthcare in an active fashion sounds pretty attractive in this backdrop.
I think it's very attractive from here, at least for next year. I don't know how 27 is going to play out, but what I do know, because we have to model out the government and all the debts, because governments around the world are the biggest buyer of all these products. So we have to understand what their balance sheet looks like and what's possible and what's impossible. And when you model out the governments, and this is something Mike Green and I talk about all the time, and it's actually happening now. It's now happened. I worried about it, that they would start spending in COVID and then realize that they can't stop. And that's what they've realized. They can't stop. And I don't know how they stop without creating a devastating catastrophe, Great Depression, and even remotely balance their budgets. I don't know how they can ever do that. And I don't mean just the US. I mean Europe and Asia, China. They cannot stop. So I think what we're going to see over the intermediate term, and probably even short term, we're going to see an ungodly amount of money printing. But it won't be episodic anymore. It will not be episodic, because the demographics leave you with a negative aggregate demand, where if your population is declining year on year, your GDP and your demand is declining year on year. You can't have debt markets, you can't have debt for these companies that have negative revenue growth. And so, they're aware of it. And so the only way they can figure to fix it right now is just spend a hell of a lot more to make the ends meet. So we don't have a debt crisis, meaning a commercial debt crisis, not just government debt crisis. This is for business and industry. And so they spend until they can't. And well, we just found out when that is. It's now. Because we've already started printing money on the short end of the yield curve, $400 billion. Thank you very much. Nobody even blinked an eye. And you remember that, Paisley, in December. I fell off my chair when he did that. So it started. Japan has inflation, a broken bond market, and they can't stop printing. So they're going to make up all kinds of excuses as to why they can't stop printing. It's simply because if they do, corporate debt goes bad. Businesses go bankrupt because the aggregate demand is negative, not positive, because the population is negative, not positive. So they have to, and once they can't borrow money to do it anymore, which is now, they will print the money. And when you model out the demographics, I mean, you're looking 50 years out and it looks like this. It's very, very difficult to heavily tax a population and expect them to have children young, and a lot of them. And that's, I think, personally, I think that was it. We overtaxed the population. And this was the outcome. It took 30 years to get there, but here we are. And now it's an outcome you can't do. And when I sit down with my kids, like our generation, Paisley, and I think what are you, like 40 years younger than me? Yeah, you are. Our generation, it was about a communications explosion in your hand. And that's what it really is. Incredible innovation in materials, medicine, you name it. But our kids, what they are is, single men and women in a 1-bedroom apartment with 3 cats that never had a family. And that's what it's going to look like for you can see the numbers now. The birth rate in some countries is, they're basically going to lose a third of their population across the board over the next 30 years.
Yeah, I wonder
when that happens.
Some of the research that, Mike Green has put out, of course, as you alluded to, is just the cost of making ends meet. Like, I ponder every day. I live in a very affluent part of the country, and you walk around and you wonder how on one income a family can have 3-4 kids without having any kind of family support. It leads all back to, like you said, is like population and trends. And all of that even starts to bleed into thinking about the use of AI and being able to reduce, headcount at firms and be more efficient with your time. And like all of this, a lot of it's AI tech related, but I think as it relates to the healthcare sector as well, it starts to become really interesting in what types of drugs and trends and themes are rising to the surface. And we kind of started today's conversation around longevity. And you can start to see how that's definitely ripe for kind of a booming part of this market in the next 5 to 10 years.
Yeah, I think further, it'll be about 10 years, but I am hopeful. I like where it's going.
So Mike, just to kind of piggyback on this conversation. So like, if I'm hearing you correctly, a lot of challenges with demographics and, not having any more children, but then, the people that are retired are living longer. How does that, I'm just thinking Social Security, I'm thinking pensions, right? I know Paisley and I are both in California. And so I know that the pensions aren't great when it comes to like state employees and, a lot of companies have moved away from pensions, but Social Security is like the biggest of all, right? How does that, do we ever get a politician that actually addresses that and that does something about it?
No, never. You will, though, in 2030. So when I say never, it's only because we're going to have a disaster happen in 32. So where the Social Security funds, they have to actually raise taxes in order to pay that bill. And it gets worse every year forever. Or they have to borrow more.
Wait,
So
do you mean I'm not going to get Social Security?
No, you will. It's just
I
the
will.
dollars
Okay.
that you get will be worthless. So
You're not going to get as much.
you'll get Social Security. It just won't be terribly secure.
Social,
and that's the only out. And that's what I look at. And then you look at the net interest that they're going to have to pay on this debt. And it's going to end up being like, 40%. By the end of the decade, it's going to be like 50% of tax input. Half goes out to pay interest. I mean, you can't have a functioning nation. So what they're going to do is print. And they're going to fake it until people show up with pitchforks and torches on the front lawn of the Fed. And I have to submit that there's going to be a moment where the Fed will become a household name. That'll be the day, right? Everyone will be like, "Oh, that Fed," but it'll become a huge problem because the alternative is they allow us to have a correction where the debt goes bad. You have to remember all these pension funds are loaded up to their eyeballs on all this crap in California, everywhere.
Everywhere.
And so they can't let it default because then all the pensions are upside down too. And that's why they cannot. That's why whenever you see a cloud on the horizon for the economy, the Fed goes running out there, the Treasury goes running out there. I mean, just even little clouds, even a chance of showers, right? They're just, spraying money out there, anything but that, because they know that if they ever get behind the ball on that, they're in incredible trouble, like cataclysmic trouble. So, and that's what's different now versus 2008.
Yeah.
And I feel like, this goes obviously a little off topic with healthcare, but a lot of what I read I've been reading as of late, is around the fact that this buy the dip mentality that many of us have become accustomed to, we should not rest on that any longer because the Fed is in a bit of a rock and a hard place. But that what I guess I'm hearing you say is that that kind of continued by the dip, the Fed put type mentality is here no longer.
Yes, it is. But we also have to remember that us three are on that now on the far end of the investor. Think of investors as a bell curve, right? And when we were thinking about this 10 years ago, we were kind of in the middle being age, the age of an investor, investor, whatever. We were in the middle. And now we're further along on the end. And to our left, it's filled with younger people that are coming in. Millennials, Gen Z. They don't know what a down market is.
Yeah.
So they have a different mentality. So now the majority of the market has a different mentality than us. We're the minority now in active management. The younger generation is now the majority of voters. They are going to be controlling the vote in the next general election. They're going to be choosing a president, not us. It's not us. In aggregate, it's them. And they have a mindset. And half of that population in Gen Z grew up with an iPhone in their hand from 2 years old. And so they only know instant gratification. That's all they know. Dopamine and instant gratification. It rewires the brain. And so they need it now. And I'll give you an example. Gen Z, they don't go to Vegas at all. And even the older or younger millennials, they don't go to Vegas either. This is why Vegas is a disaster. Because why would I get on a plane and go to Vegas? That's too much of a delay to get my dopamine. I can do it right here on my phone, right here.
Go on their phone.
I can do FanDuel and watch a sports game. So I can gamble anywhere I want to get that dopamine. I don't have to see
it in California. So I still go to Vegas.
Oh, it's out? Oh, okay. You still go to Vegas.
We can't do the sports betting on the phone, right? In California, I don't think we can. But
so
that's why the poly market starts to that gives us our fix, I think.
It's fascinating how the population and the mindset has changed as the demographics change. So, and these this group of people only knows mega buy the dip because it never can go down. And we've heard that before. It's a great time to buy a house in '07. Housing prices never go down. I mean, this is what they believe because that's what it always was for them, for us. Houses went up from 1980 to 2007.
Kind of like treasury yields went down, home prices went up.
Yeah.
It's almost like they're correlated.
And I feel like back then in 2007, even the big firms, Goldman Sachs, everyone, all of them, they basically said, well, they're not going to go down. So we're just going to repackage these things and right. And then we realized that it was kind of a house of cards.
Eventually, that's what it turns into. Private credit very likely is that because it's so opaque, it has to be bad.
Yeah.
You can't even see what it is. So it has to be super bad. And and so that's one of the reasons why the argument is we have to get interest rates down. We have to get interest rates down. But then when I look at the requirements for spending in order to prevent a cataclysmic depression, those requirements are incredibly high. So I don't know how we get out of it. Now, we could, to a degree, with AI and with greater efficiency. But as you know, and you're seeing it right now, where a lot of white collar jobs are being lost, it could be over the next year, 6% of white collar jobs get white. That'll put us into a recession too.
Yeah.
Ultimately, it'll be great. A lot more productivity per human, higher margins moving forward. And that would be probably really good for stocks and the economy. But again, the big issues we have when I go back to it, it's debt and demographics. And those you can't move them. And so that's one way that Pink is very different than others, is that we think a lot about this and how to structure the book and when. And so tactically, Pink tends to do a bit better than most.
Mike, do you think that the next recession that we have, and who knows when that will be, but do you think that the government is going to actually take advantage of lower interest rates, much lower interest rates, and try to refinance some of the debt? Because that's something that we kind of discussed, that they didn't really do that during the pandemic. I mean, here we had 10-year bonds yielding 50 basis points. That would have been a great opportunity to issue a lot of long-term debt, cancel out some of the higher interest debt. But they didn't do that.
Well, they get a pause if this AI actually does manifest in much higher margins everywhere. We could see a really amazing renaissance where GDP through productivity is up so much more, and then we will actually get closer to balancing the budget. They'll be able to spend less. And I think that may be a big save. But at the same time, we're going to lose a lot of employees in the near term. So I think the next 2 years, it's going to be pretty topsy-turvy. And right now, as I'm looking at 27, I'm very, very, very bearish. I'm very, very concerned about that. So, and it really has a lot to do with the comps and the percolations that we're seeing in credit. I don't think they go away. I think it gets worse. And we start seeing bigger blow-ups as people lose their jobs. And remember, white-collar people have mortgages, kids in private school, leased cars. It's different than the lower end. This is real white-collar firings. And they're going to have real difficulty getting a job that paid as much.
And there's probably a lot more leverage in the system from them.
Yeah, from them. A lot more leverage.
Lower income. Yeah.
We haven't seen that ever happen without a recession occurring at the same time. And meaning the recession is what drives it. And the recession is usually brought about by a credit event. Here we have an innovation event that is going to end up causing this, what I believe will be a recession in 27. And but don't worry, they're going to print a lot of money. So there'll be lots of opportunities. So it's not doom and gloom. We will all forge on and forge ahead, and there'll be tremendous opportunities. We just have to be cognizant of the pathway between A and B.
Yeah.
It's never straight.
I feel like that's the benefit of active management too, is that you're not just stuck with whatever the index is. You can own all kinds of different things. Saw one of your large holding was like a line, which is an Invisalign, right?
Yes.
And like they're not, I don't think they even show up very big at all in the index, but this is fantastic.
No. Align's really interesting, and part of the trade is their demographic that would use Align is going to be getting a pretty meaningful tax refund check in about a month. And the Align is essentially guiding to very sleepy growth. It was trading at 12 times, and they're going to grow at 3.5%, 4% on the top line. They have a great product.
Yeah.
But millions of families are going to run into $3,000 to $10,000 refunds that they didn't expect.
Yeah.
And so what are they going to do in healthcare that I can buy, right? Warby Parker.
Yeah.
I'm starting to think, Mike, that you've talked to my dentist, because every time I go in there, they're trying to huck Invisalign at me. So this feels like
yeah, they
you've been
do.
talking to my dentist.
You got a hot $3,000 check in your pocket, and you'll be like, "Whoa, found money."
Why not?
So anyway, so if they end up growing instead of 3%, 7%, which could easily happen very quickly, the stock's going to go up like 70%. Because it's very, very high margin to the bottom line for them.
Yep.
It's just
and I look at the technicals, Mike, and so I look at a company like Align, and I see that this is like there's not much more bad news. It's really, really bad. Yeah. And so like this is a candidate for a trend reversal. That trend reverses, the quality improves, all those things, and then you get momentum, and then you're off to the races.
And it's a multi-year. We've been de facto short Align the whole 4 years.
Yeah.
So, and remember, you're like, well, what happened last time Align really went to the moon? Everyone got a giant check in their pocket in 2021. And that was the last time Align went to the moon. Guess what's happening? The same thing.
You're going to get another check. Interesting.
And the stock has barely moved yet. And so I look at this and I say, oh, my peers have not figured this out.
You know what I'm wondering too? The people that are listening to this episode right now are probably thinking, you know what? Maybe I will take that refund check and put it towards Invisalign. So this is self-fulfilling.
No, don't do that. I need you to put it in pink.
Yeah, put it
in pink.
Wonderful. Well, I know we are over time here. Thank you, Mike, for affording us your time and expertise. I think this is so topical, just given all the things we've just discussed, and then the fact that you're investing well and doing well through the net proceeds being donated to Susan G. Komen in the Pink Fund. So very appreciative of that. Super excited to follow along on Max's journey as well. I'm sure you're very proud. So that's all I have. Anything else from you, Jim?
I just have one other question about just expenses, healthcare expenses. Do you see that these, because it's very, very expensive, and I know part of it is the R&D, but like as maybe AI kind of brings some of the cost down, the R&D expenses, do you see that expenses come down at all, or does it just get worse?
We do have we have a fix for instance, the cost of drugs. And by the way, the cost of drugs is just a cost that people see. The real cost of healthcare isn't the drugs. It's all the end of life care.
Yeah, HMO and all the other stuff.
Yeah. All of it.
Wow.
So, but people point to drugs because you can, right? And so we do have it. It's called the patent system. These drugs are only live for about 10 years. And then that's it. And they go generic and the price drops by 90%. And that's how it's been going. And right now, people might be upset because we've had an explosion of innovative drugs. Well, many of them will be going generic over the next 5 years. Novo Nordisk's injectable GLP-1 goes generic in 2032, 6 years. It'll be 90% cheaper and available to everyone. So, yeah, there is a fix to it. But they keep innovating, and everyone wants the newest innovative doodad. What's going to be really neat, though, over the next 6 years, there are many, like the oncology drugs, Keytruda and nivolumab, Bristol and Merck, they're going off in 27, 28, 28. And so that's going to be huge. So now those charges for treating your cancer with immunotherapy are going to drop by 90%. Maybe not as much, maybe 80, but it's still a huge drop.
Yeah.
And so we do have a built-in price control called the patent system.
Yeah. We just hopefully we can bring in all the other healthcare related expenses, going to the doctor, all those.
The hard question I have for you, and I'll always ask someone because they'll complain about drug prices, and I'll ask them, what day is it that you want to die? Invariably, the answer is not today. So healthcare is going to be expensive because it's the one thing that you totally need is to be alive. And that's it. So there will always be a great desire to live well, live better, and live forever.
Yeah.
And that's all of our goal.
Yeah.
When are you dying? When are you checking out? Never. My grandma lived to 100 years old. I want to live to 200.
I love it. This has been so fantastic, Mike. Thank you so much for your time. And Paisley, thank you for helping with this. And I really enjoyed our conversation.
Come and dance on our floor.